Hey, good morning, everyone. Good morning. How's
Good
everybody?
morning. Good, and you?
Good morning. Good morning.
Yeah, hi, good morning. I
Good
said
morning,
to
Professor.
good morning, Anna. Good morning, Richard. Um, all righty. We have six people in the collaborate. Let's see how many people are in the discussion. Today's forum. Why isn't it moving? Okay. So I see seven people. So I guess one person is still. Yeah, I see seven. Okay, so the numbers are matching. So everyone in the discussion board is in the collaborate session. Also, just in case if you forgot, I mean, everyone here remembers. That's why you're all, that's why seven and seven, right? Numbers. That's why numbers match. But you must always first sign into the discussion board because that is your physical proof of attendance. And otherwise your attendance is not validated. So please make your attendance count. Now, so in our last class, I think this is, yeah. In our last class, I was trying to wrap up. Excuse me, just a second. I got a frog. My throat. Yes, I was trying to wrap up the this personal income tax example. Actually, okay, some lozenge for my throat. Um, the um, the crux of the model was already discussed last time. So here, uh, since this was the 2018 income tax schedule, right? Um, you might find, these numbers slightly different in the original file you downloaded. Because in the original, these numbers didn't match, but I matched them because anyway, the the reality is, mm, um, this is the tax brackets that we go by now, whether we like it or not. Um, so I simply made it equal to this column, right, and dragged it down so everything is. And I didn't use the last bracket. Um, I mean, I could do that, but there's no point because in reality we don't. Oh, it looks like 37% was the bracket that existed before, prior to 2018. Because in 2018, so let me just delete this because the numbers were just the same, right? Uh, so they uh, yeah, if I remember correctly, Donald Trump was bragging that he simplify the tax brackets to 5, from 7 to 5, and this is like 2, 4, still 6 brackets, 6 brackets. Um, but the point is, so I used latest tax bracket, and using also this column, married filing jointly, because obviously we have 2 people, right, Joe and Sue. So this column, right? Therefore, all these bounds, right, lower bound and upper bound, oops, it's acting up. My mouse is acting up. And simply the same idea. I used, this upper bound, right? And of course, the copied, referred to this and then dragged it down. And everything, the whole column is copied, as you can see, right? It's all pointing to the column I. So, and the lower bounds, of course, it starts from 0, right? And then I just added $1, added $1 to this for the lower bound of the upper bracket. And here, in the, this got to be, 10% bracket. In the 10% bracket, we simply, I used, minimum of the B17 and D20, whichever is, then smaller, will be, multiplied by 20%, 20%, 10%, which is an A20. Whichever is smaller will be applied 10% tax rate. Of course, our taxable income is greater than this upper bound, so then we pay. Then this upper bound will be picked, and 10% will be applied to that. So we pay only 10% for the first layer of our income, and then since our taxable income is greater than the first upper bound, right? Then we will need to find the difference between our taxable income, and also our taxable income is less than this. But it's us that if you think like that, you are making that decision. You don't have to make that decision. You just give the logic. Just give the logic to the computer. Just give the logic to Excel, and let Excel automatically find that. So the logic is, so then if our taxable income is greater than this, then we go into the next bracket. And in the next bracket, so 12% is the next tax rate. And once again, if our taxable income is greater than or less than, right? If it is less than this upper bound, right? If it is less than this upper bound, then it will be our taxable income minus this, because we already paid 10% for this layer. So the next layer to pay the taxes will be, whatever is our taxable income, if it is less than this, and the difference between that and this, right? So that's what it means. Minimum of B17 and D21, right? Whichever is smaller. From that, we will subtract D20 so that the only the difference will be applied. The tax rate, 12% tax rate will be applied to only to that portion, right? Okay. And So, and it is the case. Otherwise zero. Actually, this formula, this command is a little little flawed. I mean, it works, but it's incomplete. I'm gonna come back with a complete one, because if our taxable income is not if our taxable income is greater than this, then it should be able to handle that. Then we will have to do we'll still have to do the same thing, and then the exceeding portion, as for the exceeding portion, there should be part of the command or the formula that should address the exceeding portion. But the exceeding portion will be handled here. So for just this bracket, this is enough. But in a way, I feel this is not. I feel this is, it could be more complete than this. But for now, it serves the purpose. It doesn't have to be more complicated. If it serves the purpose, then that makes, that is okay. So so it only applies, this tax rate will only apply when our taxable income is below this. So even if I leave this otherwise as zero, it doesn't really matter. I mean, it doesn't hurt the command. So therefore, the difference between our taxable income and this is automatically picked, and 12% is applied. So there you go. And then, although I know our taxable income doesn't go beyond this, but still the model should be complete. I mean, what if, in case our taxable income is greater than second bracket, third bracket, fourth bracket? I mean, so I drag it all the way down. I dragged it all the way down, right? In other words, I dragged. Do you guys have this file in front of you? When I show you this model, right, you must have it in front of you, and you must do it also with me at the same time. Otherwise, you will never get the hang of it. You'll never get the hang of it if you don't do this with me. Okay? So let me just make sure. Do you, do you have this file in front of you?
Yeah, I have it open.
Anna, yeah, you have it open in front of. Good. Ethan, do you have it open in front of you?
Yes.
Okay, good. Janet, do you have it open in front of you?
Yes.
Janet? Okay, good. And I want you to do it with me, right? Kula, do you have it open in front of you?
Yeah.
Kula? Okay, good. I said to you too. Okay. Richard, do you have this file open in front of you, Richard?
Yes, sir.
Okay, good. Yenchu, do you have this file open in front of you?
Yes.
Okay, good. Only 7 people, and the number hasn't increased at all. What happened? I have at least like 20 people in this class. Only 7. All right. Well, you reap as the the saying goes, and you reap as you sow, right? This is some biblical quote, biblical saying, I think in Proverbs or Psalm or whatever. You reap as you sow. So if you if you are serious about this class and actively and enthusiastically participating, you will have a good result. It goes without saying. But people who are not participating, it's always commensurate. It's always in direct proportion. So the formulas that are here, first of all, this one, right? If you missed it, please please put it in there, right? Please put it in there if you missed it. Okay, let me blow it up a little. It's 100%. Well, the screen, the size, what should I call it? The viewing size, the screen size isn't too small, right? You can read everything clearly.
Yeah.
Okay, good. I won't magnify anymore. I won't blow it up. All right. So please, if you missed it, please type it in. All right. Please catch up now. Okay. And don't manually type in. I mean, something like minimum you can type in, but the cell locations or cell address, you don't have to type it in. You just click, right? B17. Use your mouse, right? Using your mouse, you just click it in. Comma, there you will have to type it in. But the cell reference, right? You just click it in. Okay, and then 12%. This is the formula, right? B17, right? You click it in, and what did I say last time? You have to lock it because you're going to copy and drag it down, and you don't want this our taxable income, the cell that our taxable income is in B17, and you don't want that to change because when you drag it down, it's going to change. So you lock it. And so first click in B17 and then hit F4. If you hit F4, you'll see this dollar signs, and that means it's locked. And then the rest of it, here, B17 again, so you lock. Okay? So you're all caught up. You're all caught up to this point. Are you all caught up to this point? I will have to assume you are. So then bring your mouse to the southeast corner, right? To the southeast corner of this border, southeast corner of the border, and then you drag it down. Just gently drag it down, right? And then as you drag it down, the formula gets copied, but it will automatically adjust to the new environment, right? Like now we're still pointing to our taxable income is still B17, and since we locked it, it is still pointing to B17. But the other variables or other parameters have changed. D21 now it is the upper bound of the second bracket, right? Then A22 is the tax rate for the third bracket. And then the same logic, minimum of our either our taxable income or the upper bound of this third bracket, and whichever is smaller, we subtract the upper bound of the previous bracket, subtract that and apply this tax rate. Otherwise, zero. So it is otherwise. In this case, it is otherwise because every other tax bracket, it is otherwise because our taxable income never exceeded the upper bound of the second bracket, right? So Excel automatically picks otherwise, and so zero. Everything will be zero, right? And finally, we had taxable, we have dividends. We had dividends paid from some stocks that we own. We have, I don't know what stock, but there is, dividends were shown somewhere here. Yeah, GM. We have dividends paid from General Motors, right? You might wonder, what about the interest on Boston bonds? I told you municipal bonds are tax exempt. Municipal bonds are tax exempt, right? So it doesn't enter our calculation. And then, but dividends are, I explained this last time, dividends are paid at 15% tax rate, okay? And this is why I said I even used that that anecdote, famous anecdote, but what Warren Buffett's quote. The anecdote was actually a quote of what Warren Buffett said. Warren Buffett said, his secretary is paying more taxes than he, right? Remember that? Of course, in absolute dollar amount, he would be paying more, definitely. But what he meant was in tax rate, right? So in proportion to the income, right? His secretary is paying more portion of her income or his income than Warren Buffett. At least admitting that. I don't know. I think Warren Buffett is at least a conscionable billionaire, because he's admitting that he's paying less taxes than his secretary. So is Bill Gates. Bill Gates also feels that he's obligated to pay more taxes. But there are conscionable wealthy people and unconscionable wealthy people, like Koch brothers and Walton family and Walmart, right? Walton family, and Jeff Bezos and Elon Musk, because they don't think they have to pay more taxes. I don't know. Maybe inside they never expressed what they think about, what their positions are about the tax system. But at least Warren Buffett admitted that he needs to pay more taxes. Bill Gates also admitted that he needs to pay more taxes. And this is what I don't like about Democrats, because Democrats all vilify or demonize all wealthy people, regardless of they all I mean, there are conscionable wealthy people. The problem is unconscionable wealthy people. And wealthy people being wealthy is not to be demonized or criminalized, because if you made that fortune with your honest work, right? I mean, if you pay your taxes, fair share of taxes, and make fair share of contribution to the society, and become rich, I mean, that's something to be celebrated, right? That's something to be celebrated. I'm not against, wealthy people at all. Become wealthy, but in a fair way, right? In a fair way. And um, if you become wealthy in a fair way and you pay fair taxes, then uh, that's something to be celebrated, right? Anyway, so uh, because the wealthy people's income is mostly uh, investment income, and most uh, investment incomes are paid, at 15%. And here, capital gains and capital gains and what dividends are paid at 15%. So are they all like that? Mostly here. So I'm going to show you. This file was there. It just, I don't know why, but it wasn't triggered. It's been there all along. And if you go to our um, back to our topics folder, right? Topic 1. There are these two files. One is, solve tax example, which is, the file that you downloaded, right? And the capital gains and dividend tax treatment, this file, that's been there all along. Just, I don't know why it wasn't, visible. Um, and if you open that, uh, this is the guideline about, dividends, held for assets held for 60 days, more than 60 days. 60 days is still short term, but even if you have held the assets for more than 60 days, then 15% for those who are in the normally above 25% top tax bracket. If you're above 25% top tax bracket, 15%. Not below 25% tax bracket, zero. You don't even pay any taxes on dividends or capital gains and capital gains. So here, 25% top tax bracket. There used to be 25%, but 2018 income. Since 2018, we don't see 25, but then at least 24% bracket. Look, to fall into 24% tax bracket, as a single, you have to your not gross income, but taxable income. Your taxable income must be above 157,000, right? So how many of you fall into this category? I mean, that would be like, if you make more than 157,000, you would be like within top 5%. I would say top 5%. It isn't that top 5% isn't that, uh, that high. I mean, if you make more than 200,000, you would fall into like top 2% of the entire population, right? With 300 million population, 300 million population in the U.S. 1% is 1% is what, 30,000. Oh, no. 1% is 3 million. 3 million, right? We have 300 million population. So 1%, 2% is 6 million, right? So people who make more than 200,000 a year, it could be more than 6 million. It could be like 10 million. I don't know. But it won't be more than 10 million. And the top 5% would mean like 1.5 million, isn't that right? Top five, 15 million, 15 million, 15 million. At least 15 million would be making more than this. Um, but the rest of because median income in the U.S. median income would be somewhere around 50 to 60K median, right? Median is just the center of the distribution, not the mean. Mean is the average. And the mean would be about 50. Mean would be between 50 and, oh, okay, so I'm sorry. Mean would be, what I said was mean. Mean was, mean would be about 50 to 60K. But the median will be, because the income distribution would be, from even 0 to even, half a million or a million. So the median would be, it could be, median would be, like somewhere between, the median would be even, right in the middle. So 2.5, 250K, but the mean would be like, 50 to 60K, right? And the mode, mean, median, mode, these are three different measures of central tendency, central tendency. Mean is the average, right? Median is the exact center, right? Center of the distribution. Mode is the where the most values are, most occurrences are happening, where the most occurrences are. And the most occurrences would be uh, below, mode would be below or above mean, but in this case, the mode would be below mean. I mean, there will be more incidence of incomes below the mean, below the average, right? Uh, uh, so the distribution would look more skewed to the right tail. In other words, more it looks more cluster below the mean. So there's more distribution in the left of the mean, and there will be a long tail to the right side of the mean, right? That's the shape of the distribution. That will be the shape of the distribution. But anyway, the dividend is taxed at 15%. So you might think, oh, I will just, there's, I just reproduce that dividend here, right, by pointing to C7. I will just multiply A26 by C by this one, which is B26. I'll do. No, that is still, that is still you doing it, right? The point of doing this on Excel is to have Excel do that, right? To have Excel automatically determine. Okay. So what I did was, and all you need to do is just provide a logic. Just provide a logic to Excel. So what did I do? What I did was, if B26, which is this, is greater than 0, if there's a positive number, positive value for dividend, then it will be multiplied by this, right? It will be multiplied by this. That is the logic, right? Okay. Then it will automatically pick. If there is nothing here, then it's going to be 0, right? Automatically it's going to pick 0, right? And if there is something here, then it will execute this this command. It will execute this command, right? If b26 is greater than 0, comma, I told you first comma means and or then. If that is the case, then execute this. It will, and Excel will execute this. And then the second comma is otherwise, right? Otherwise, if that is not the case, if it is not positive, then nothing to pay there, right? Zero. So this if command is really, it comes in very handy. I'll show you also, it will come up later. And being able to use this command is really makes your life a lot easier. It's because all those things can, without, if you are doing this one by one yourself, then what's the point? You don't even have to use Excel, right? If you were to do it yourself one by one, and it will take just it will take too much time. I mean, it may not, even if it is not taking too much time. I mean, it will take more time than Excel automatically executing these commands. You just provide these commands, the logic into Excel, and then Excel will automatically execute it in one, even take a split second. It's going to do it in a split second, right? And that's the point of using Excel. And also these are all called commands, right? It's formula, but the formula is the command. You give command, you issue command to Excel, and Excel is such an obedient and reliable soldier or agent, like Man in Black or Secret Service agent. It just executes it, right, without fail and without fail and without any delay. It executes it in a split second. So it's having like a you're the boss, you issue you're the president, and just you issue an order to the Secret Service and they execute it right away, right? You're the commander, you issue an order and the soldiers execute it right away, immediately, with a ruthless military efficiency. And that's what I like about Excel, right? That ruthless efficiency, right? So that and besides, even a complex with if command, you can it's a if command is basically a logical loop, right? Logical loop, and the logical loop is the most basic algorithm. And I'm going to talk about that later. So it can be nested. It can be nested inside over and over, just like you see when I share my screen, you will see it's basically reflecting my screen, and because it is reflecting my screen, there is another screen reflected inside and another screen reflected inside. It goes on forever, right? But you see why, you understand why the screen is reflected like this, because if it is reflecting itself, if you look at yourself in the mirror and you have another mirror behind it, you will see the reflection reflected over and over and over again. In other words, you can build a command like this, right? With if command. That's what that's why if command is such a useful command. It can do the repetitive logical loop until endlessly. I mean, until it finds the solution. For human beings to do that, it will take forever. But Excel computers running the recurring logical loop, that's what the computers are good for, right? That's what the computers are good at. They can do it in a split second. So finally, we arrive at the total tax. Total tax is sum of all of this. I have already built, I mean, you don't have to build anything using just, using, auto sum. This is auto sum, and then, it will sum everything, right? So that's total tax. What is average tax rate? What is average tax rate? This small, you see, oh, that's a lowercase t. Yes, that's lowercase t, but it's also a Greek character tau. Greek character tau, of course, that's Roman alphabet T. What else can it be? And lowercase Greek characters, it's a mathematical convention. Lowercase Greek characters refer to rates, right? It refers to rates. So that means, tax rate, average tax rate. So our average tax rate will be, it's a weighted average actually, because it's not 10%, it's not 12%. It will be, and then it's not 15%. It's basically, we can divide total tax by our taxable income, right? You divide that by taxable income, and then that's the average tax rate, right? And then what's the marginal tax rate? Marginal means, always, additional, right? Additional, small increment, right? By small increment. So marginal means, if our variable increases marginally, right? There's a small increment, marginal increment. What's going to be the outcome? How the outcome will change? That's marginal. So in this tax example, marginal tax rate means, so if our taxable income is currently 77,100, but if we made one extra dollar, one additional dollar, where will that fall into? If we make one extra dollar, are we going to go into the 22% bracket? Or no? Even if we make one additional dollar, that means one additional dollar means marginal, right? Even if we make one additional dollar, we don't go into 22%. We still are here, right? Until our taxable income is 77,400, our marginal tax rate is still 12%. And beyond that, if you make one more dollar, then our marginal tax rate is 22%, because that will take us to 22% bracket, right? So you might say, yeah, that's 12% then. It must be 12%. But that, once again, that's you making that decision, right? The computer programs, if you are building a computer program, it's for us to lessen our work. I mean, to take away our work and give it to the computer, right? Those tedious things that you do by checking it visually, right? You visually check, if we make, one more dollar, we're still here. I mean, that tedious job We give it to the computer. And our job is to give the logic to the computer, right? If you're building a program, that's basically giving a logic to the computer. Logic to execute, right? So we don't do that like that. Instead, I would do it this way. Also using if command. Right? So if B17, which is our taxable income, right, plus 1, right, that's what, plus 1 more dollar, right? By adding $1 more to our taxable income, if it is greater than D21, if it goes above this, then our tax rate will be this. Otherwise, our tax rate is this, still this. Okay? That way, Excel will automatically determine, oh, adding 1 doesn't exceed this, so it will be this. Excel will pick automatically that. So, right? But then, okay, that is not complete. I mean, that is useful. That is that is workable. I mean, that's a working solution, but it's not a complete solution. Complete solution is why? Because what if our taxable income isn't this? In our example, our taxable income was only that, but our taxable income can be anything. It can fall into any range, right? Isn't that right? Then giving the command being using B17 only as the taxable, I mean B7, whatever in the B17, whatever will be in the B17, it will be B17. But comparing it with only D21 is incomplete, because if our taxable income falls into this range, right, then we should also have this. So, or if it falls here within this range, we should, the command must also include other upper bounds. So how do we make it complete? So this is how I made that complete. It may not look okay. So why isn't it? Okay. It's like this. Okay, that may look. All right, now it looks better. It looks better now. So what is this? It looks complicated. It starts with, of course, it's not showing the full thing. Of course, it starts with if B17 plus 1, right? It starts with, if B17 plus 1, right? So let me, yeah, it's showing. If B17 plus 1 is less than or equal to, that means less than or equal to, right? Less than or equal to. First, we start from this, right? If it is less than or equal to this upper bound, then it is 20%. Then it's going to be otherwise. Otherwise will have to include all the other possible scenarios, right? So that's why it looks so complicated. I don't, recommend, I don't recommend this just yet, but to give you the idea, it's the logical loop, the logical loop I was talking about. So for example, So it's like this. We have if is x greater than y, and then we can have two answers, yes or no. If it is yes, then the program stops there. If it is no, then there can be two possibilities. One is yes. Is it it's not greater than, that means it's not greater than y. So it's less than or equal to y. And then again, the answer can be yes, or it can be no. And then if it is yes, again, oh, so I should have put yes. I think I should have switched this. And this type of logical, branching out or tree, it's called actually, decision tree, but and there can be, if it is no, it stops there, or if it is yes, then is it then what am I trying to? The logic is now it's no and yes have been flipped, but if it is yes, but then the next question is then is it greater than a, maybe, right? Since I flipped that, But you get the idea, right? We can have so many, multiple layers of logical decisions that can be embedded. That can be embedded in uh, multiple layers of the logical decisions embedded in that single command. That way, but it can be endless, but if it is infinite, then endless, uh, it will be very difficult to actually build a command like this, because building the command itself becomes a very tedious job. But oops, since in this case we have a finite cases, right? Finite cases. Our tax brackets are only 6. There are only 6 tax brackets, right? So the logical loop won't have to be, the loop doesn't have to be more than 6, right? The embedded if commands, are embedded over and over. First, is our adding one more dollar to our taxable income, which is B17. Are we, is that less than D20, right? If it is less than D20, it's just simple. It will stop there, A20. It will stop at A20. But then if not, it will keep, embedding this loop, this logical decision, logical question, Then if it is not less than this, then is it less than this, right? Is it less than this? And if it is yes, then it will stop here at 12%. If it is not, the next logical decision, right? Is it, if it is not, so actually, it should be on the no. It should have been on the no. If it is not, is it greater than this? I mean, is it less than this? If it is less than this, then still the marginal tax rate will be this, right? And that is, so all of this string of, if commands are embedded within itself, right? Embedded within the previous command, and embedded within, previous if command, and which is also embedded in the previous if command, right? In the otherwise part of the command, and so on and on and on. In other words, then finally, so that's why I'm, using this analogy. It's like this. This reflection is embedded in this reflection, right? But this reflection is embedded in this reflection. This reflection is embedded in this. This one is embedded in this. So in other words, it can be called embedded loop or nested loop. That this one is nested in this. 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 Right? But of course, I'm not asking you to. At this point, I'm not asking you to do that, right? So actually, this got this got mixed up. Actually, it should be no should be here. So now I'm gonna fix it later. In other words, no should be here, no should be here, and this should be the case of. I mean, this is what happens if it is no, right, and so on. So this way, we came to the conclusion of the personal income tax, right? Personal income tax. We're gonna move on to the corporate income tax, right? After the break. So I think this is about the time to take a 10-minute break. It's 10:34, so we'll reconvene at 10:44. Okay. Alrighty. So 10 minutes.
Thank you.
Alrighty. I'll see you soon.
Okay.
All right, we're back. We're back. I think 10 minutes fly by so fast. I just, during those 10 minutes, I just fixed my diagram, right? Can everyone see it now? I mean, I just did it impromptu, so the diagram was, all messed up. But uh, it's more like this, to make it. So the logic is like this. We want to see um, if x is less than y. If it is less than y, then it will stop there. I mean, it will execute whatever it should execute. If the answer is yes, then Excel will execute whatever the command it must execute, and it will stop there. If it is not, then it will further continue to compare if because x is not greater than y, so it will continue to check. Uh, so that means if it is no, then if x is greater than y, then is it less than w? It's greater than y, but is it less than w? If the answer is yes, then it will stop. It will execute whatever the command it will execute. It will have to execute, right? Uh, so it will do W, whatever the command it's supposed to execute, and stop there, right? If it is no, then further question. Then is it greater? It's greater than W, but obviously it is no. So that means it's greater than W. But is it then less than V? And the answer can be yes or no. If it is yes, then it will execute V and stop there. If no, it will continue with the question. Is it then, it's greater than V, but, then is it less than U? And the answer will, again, bifurcate, right? It will fork in two ways, yes or no. If it is yes, it will execute the command, whatever command is supposed to execute. If not, it will, ask the question, is it then, less than T? If it is less than T, then, yes. If it is yes, it will stop, execute whatever the command is, and it will stop. And then if no, then it will continue to ask, is it less than S? And so on, right? You understand? That's basically that's basically the logic behind. What am I doing? Oh, that's basically come on, why isn't okay? That's basically right. That's basically this command, right? Uh, it doesn't have to be endless, right? Because the logic will stop at some point because we have only 6 tax brackets. So the nested or embedded if commands cannot exceed 6, right? So anyway, that's the diagram. That's the logic behind it. Now let's move on to the corporate tax example. Okay. Uh, I don't know if it is fully visible to you. It's kind of the cell is truncated. You can, if it is not fully visible, you can move. You can bring your cursor here and pull it down, right? Pull it down until you can see the full thing. Okay. Is everyone there? I just want to know if everyone. So can everyone see the question? Can everyone see the question?
Yeah, it is visible.
Okay, good. And so let me make make it just a little, let me blow it up, but just a little so I can read it easily. So the problem is like this. The Dakota Corporation had a 2015 taxable income of 31,500,000 from operations after all operating costs. So what does that mean? After all operating expenses, right? After all OPEX, right? They had taxable income of this. Actually, so this is EBT, taxable income, right? But then it's EBIT because it says after all operating expenses. So after operating expenses, right? After OPEX, you arrive at EBIT, right? So the EBIT is 31.5 million. Okay, 31.5 million. It says taxable income. So isn't it EBT? No, not yet, because before it says before interest of 8.4 million, before interest of 8.4 million, right? So that means this is EBIT before interest and taxes. It's a taxable income, but before interest. So that's EBIT clearly. So I put, 31.5 million there. And then I could put interest right after that, but then, we don't have, then, it will get kind of complicated because I want to put all the, because then it will be, positive, negative, or cash inflow, cash outflow happening, all, chaotically. So it's always important to organize it neatly, to neatly organize by, cash inflow and cash outflow. So I'm putting all cash inflows first and then cash outflows later. Because this interest charges, that's the interest you have to pay, so that's going to be cash outflow. So here, before interest, what then they say dividend received of 740K. 3, dividends paid of 5.2 million, right? Now dividend paid is after taxes, right? Think about it. Dividend is paid out from EAT, earnings after taxes. So this dividend to be paid out, dividend to be paid out is none of our concern. Okay, for our tax calculation purpose, dividend paid is none of our concern. So you can forget about it. But we have dividends received. That's our income, and dividends received, right? For personal income, dividends are treated. Dividends will be paid at 15%, but this is not personal income. This is corporate income. This is part of the taxable income. Dividend received is part of the taxable income. But you see, I told you to download that tax treatment file. Here. If a corporation receives dividends from another corporation, it will have tax deduction of 70% of dividend it receives. So in other words, only 30% is taxable, 30%. So it's only for corporations. If one corporation owns another corporate. Owns doesn't mean that it is, wholly owning it, right? It means simply, I mean, I own a partial ownership, right? It means partial ownership always, because I own Apple. I'm an owner of Apple, but I own only about 50 shares. 50 shares would be not even 0.0000001%, right? Minority shareholder, minority shareholder. So, but you can still say I own Apple, right? In part, in very, small, insignificant part, right? Just like that, companies own other companies in small proportion, right? So they receive dividends. And a lot of companies cross-own each other. Cross-own. You understand? Cross-own. So if a corporation receives dividends from another corporation, it is taxed for only 30% of it. Only for 30% of it, right? If the corporation receiving the dividend owns 20% or more, now 20% is already a huge majority shareholder, right? Most large shareholders, nobody has supermajority, right? Nobody can. I've been telling you, the ownership must be diffused, and by law, more than 25% ownership. If I'm not mistaken, the law there is no law that prohibits I mean, but as long as it is a C corporation, right? And I guess there is there must be some there must be some different clause, depending on the size of the company, like market capitalization. But officially, I don't think there is any law that prohibits, ownership, greater ownership, ownership greater than 20% or 25%. But it's just not, think about it, the size of the company. I mean, they say Amazon is $2 trillion company. Apple is a $2 trillion company. What does that mean? That's the market capitalization, right? That means the total value, market value of the shares outstanding. Then, if it is like $2 trillion, who can own 51% of 2 trillion would be 1 trillion 51%, so 1 trillion and 1 trillion and 20 billion, right? 1 trillion and 20 billion dollars. Who has that kind of money to own 51%, the supermajority of Amazon or Apple? Someone must be, really wealthy enough to own, to buy, to have enough cash to mobilize, right? 1 trillion $20 billion. $1 trillion and $20 billion. Mm-hmm. Who can mobilize that kind of money? I don't think. So, a huge corporations is difficult to, almost impossible to single-handedly own the supermajority of the shares, right? So the ownership is naturally that way diffused, right? It will have to be diffused naturally, but it's naturally diffused. And the major shareholders generally have like 11, 12, 13%, not more than 50%. That's usually the case. At most 15%. But let's say, and I told you corporations cross-own each other. If the corporation receiving the dividend owns 80%, 20% or more, however, then the amount of deduction increases to 80%. So that means company A owns more than 20% of company B. Then the dividends received, only 20% of the dividend received will be taxable. Okay, the other 80% is not. Excuse me. The other 80% is tax-free. So I assumed two scenarios, right? I mean, simply, adding some numbers there, changing some numbers, and we can try different scenarios. This one clearly, the dividends, only 30% of the dividends received is taxable. This case, only 20% of the dividends received is taxable. And here, dividends received 30%. So actually, taxable dividend will be this times this. Okay. Then sum of all of these, right? Cannot be like this. I'm sorry. 30% cannot be added, right? So it's going to be B6, B7, and B9. Okay, that's the EBIT, right? Plus taxable dividend. Then interest is this. Then EBT will be this minus this. And then use the tax schedule in table 2.3 to calculate the Dakota's income tax liability. So tax liability, okay, table 2.3, they gave, 2018 because that's the latest one. So now, corporate income tax is different from personal income tax. What is the biggest difference? You remember, personal income tax goes through every tax bracket, right? Your taxable income goes through every tax bracket. So your average tax rate, also called effective tax rate, your effective tax rate will be somewhere between your top tax rate and the lowest tax rate. In this case, we can tell it will be below your effective tax rate will be below your top tax rate. It is indeed below because it's the weighted average, right? Now, in corporate tax, it doesn't go through every bracket. It doesn't go through every bracket. Okay? Instead, it goes by the top tax bracket. So your taxable income is 24 million. Where does that 24 million fall into? Oh, it falls into this tax bracket. This bracket. Then, then it's 39%. So we just we don't go through every bracket. We just pay 39. But 39 of entire income? No. Entire taxable income? No. First, in every tax bracket, there is base base tax amount. I mean, not base tax. There is, designated, tax amount on. So we pay this first, and then the difference between our EBT, right, and the lower bound, right, for this, right, for this portion, right, so this minus this, for this minus this, we pay 39%. So basically we pay this, and on top of that, the difference between this and this will be taxed at this rate, the top tax rate. Okay, so what you do will be, what you will do is, we are in this range, in this bracket. So this plus the difference between our EBT and minus this. Okay. Times 39%. All right. And then average tax rate. So you might wonder, oh, then still you doing it. Is there like if command? Yeah, we can do that. We can do that. We'll just take more time to build that command. So I'm gonna show you that command later. But for now, we'll just we'll just settle for this, right, for now. But later, I will show you how to build it, like this. It's simple, because all you need to do is using if command. If using, if this is greater than this, 0, right? Otherwise, do this. If this is greater than, this, 0, otherwise, do this, this time, this plus, the difference between the two. And you drag it down, right? And then all of these will be 0, 0, 0, 0, because, there won't be any, and then only, this will click, and it will automatically do this. Average tax rate, it's always the tax liability divided by, right, the taxable income. Marginal tax rate, again, if this plus 1, right, it's less, if it is less than the upper bound here, then still this. Otherwise, if it is not less than that, then this. Okay. And therefore, right, we will still be here, right? Oh, no. What? Our taxable income is where? 32, 24, I'm sorry, 24 million. Oh, 24 million, what am I doing? 24 million, which will be is 24 million. Let's see 23. Still 38%. Otherwise 35. Okay. So because actually our taxable income is even in the highest bracket. So actually it will always be 35% because there's no higher uh, a tax rate than 35. Oh, I thought somehow tax. Let's take a look at it. Why did I pick this? I was still in the oh, that's not right, because it is 24,000. Somehow I thought it was 2400. So then it's actually our taxable income is greater than 18 million, right? So the base amount is this. Base amount is this, and then the lower bound is this. Tax rate is 35. It should have been like this. But our tax went down. I mean, previously it was 9 million, right? It was 9 million previously, right? Why? How come we are, because the tax rate, we have $24 million, we have $24 million, right, for taxable income. Look at the tax rate. First, it goes up to 39%. This is the highest tax rate. And then goes down. Goes up, and then goes down. So this is kind of weird, right? I thought you might say, you might scratch your head. I thought the tax system was progressive. And it is progressive, certainly progressive in personal income tax, but in corporate income tax, it doesn't seem progressive, right? Actually, it is still progressive, right? Why? Look at the base payment, right? You are paying, like 6 million. This is all capturing, right? This is progressive already, right? So, because this is already capturing progressively the base, right? The tax rate is it's called showing sinusoidal pattern. Sinusoidal means sine curve, like sine curve. It's going up, going down, going up, right? It's showing the sine curve, right? It's not exact sine curve. It goes up and slightly down, and then up and down. But considering the base pay, right? When I say base pay, it means it's a different thing than pay on this base. This base means your uh, your taxable income, right? If your taxable income is, your tax base, right? So on your taxable income, on that base, you pay this, right? So this is already built in. And this amount, of course, when tax law changes, if they change the tax code, it can be adjusted. Um, so this number is kind of arbitrary, right? It's already built in. There's nothing I can do about it, right? Because it's what the Congress has, put into place. But that's how you do the corporate tax. Okay, that's how you do the corporate tax. Um, any questions so far? Any questions? It's very quiet. So we're down to 6 people. Where did one go? Huh? It looks like Richard is not here anymore. But Anna, any questions so far, Anna?
No,
Any
I noticed too that it wasn't the right tax bracket. So then it's just the flat rate of 35, right?
Yeah,
For
yeah,
example.
yeah. I thought somehow I got carried away because our in the income tax we were somewhere here. So I thought somewhere suddenly I got carried away and I picked maybe it was 39%. Maybe that was the decoy. I was probably decoyed by that. Um, but because our it's 24 million, right? Obviously, we
I
fall
have
here.
another question though.
Yeah, yeah, yeah.
So for the pay that on this the base pay, do they pay
Hmm.
each one or do they pay just the previous one, the one under their tax bracket?
No, just this one, just this one,
Oh,
right? Okay. The previous no, the corporate tax. It's always top tax rate, and uh, you pay the applicable top tax rate on your EBT, and also the base pay is just one base pay. Depends on so uh, a lot of but think about it because it stops here, right? Um, but it's 35%. You might wonder, what about giant corporations like Amazon or Google? They would be making billions of dollars a year. Taxable income would be billions of dollars. Still, then there's nothing more than 35%. They will pay 35%, and for such companies, uh, base amount would be very small if you think about it. They are making billions of dollars, and then they only pay 6 million base, 6 million, base tax. Um, and then on top of all that, uh, they use a lot of tax loopholes and avoid paying taxes. They pay effectively like close to zero. Um, and what they have been doing so far, um, their headquarters, Google, Apple, Facebook, Google, Apple, their headquarters are located in Ireland, right? Legally, legal headquarter is in Ireland. Why in Ireland? Dublin, Ireland. Why? Because their their corporate tax system is in favor of these companies. In other words, they can pay like less than 10% or less than 5%, 5%. So it's offshoring, in a way, it's offshoring. They set up a paper company there and designated as as the headquarter of operations. Then they pay taxes, less than 5% taxes there. And of course, Ireland deliberately set it up that way so that it can invite a lot of giant corporations to their soil. And then for Ireland, it's a tax revenue, huge tax revenue that they couldn't even think of, right? So it's a kind of win-win for both of them. Amazon, Google, Facebook, um, and both Irish government. It's a win-win. They save on taxes, and for Irish government, it's a huge tax revenue that would otherwise have been non-existent, right? But then um, it cannot go on forever. I mean, it was yesterday. I mean, the movement has been around for the whole year. Have you ever heard of global minimum tax? Global minimum? Anybody?
No.
No? You haven't heard of global minimum tax? It's been all on the news, for the entire year.
Maybe I barely watched the news. That's why I didn't hear it. Maybe that's why.
What? You don't watch news?
I watch it, but not as much as I should. So,
Yeah, yeah, but you don't have to watch news on TV, I mean, Wall Street Journal, New York Times, or
alright.
right, Yahoo Finance. It's always the headline. Something like this is the headline. Yeah.
Got
Throughout almost 1 year, these governments have been talking about setting the minimum tax rate for corporations, multinational corporations globally, right? And so they came to the agreement yesterday, and the talk was, the proposal has been for 1 year, and there has been multi-party, multilateral uh, discussions for the whole year for 15% minimum tax rate, and they signed that agreement yesterday. That means no matter what government in the world, they will impose 15% minimum corporate tax rate. That way, so then the Irish government probably was very reluctant, right? Obviously. Why? Because there would be, then less tax revenue for them, right? Uh, but all the other, Irish government, obviously would be. Um, uh, U.S. government will always, flex muscle, on other. And Irish government knows, they are kind of, tax haven. They were providing tax haven for these large corporations. So there's no legitimate reason to refuse to cooperate, right? And the countries that have these, mainly U.S. but also UK, or uh, companies that have these giant, Switzerland, and companies that have these giant, multinational corporations. Uh, they all have only, only something to gain from this, because Google and Facebook, Amazon can no longer run away from their borders, right? Under the pretense of, I mean, uh, under the pretense that their headquarter is in Ireland, right? And when there's always there's a tax treaty between these countries. All the countries in the world, not all the countries, but most of the Western developed economies are in mutual tax treaty. Which means no double taxation, right? The treaty about no double taxation. So if you pay taxes in one country, you don't pay taxes in another country within the treaty, right? Within other countries within the treaty. So a lot of U.S. expats, American citizens, U.S. citizens in the overseas, expats working in the overseas, when they work, they normally their income occurred in that country. So normally they would pay taxes to the government of that country, right? But then they can choose to pay taxes to U.S. government, and they do always. Why? And then they don't have to pay taxes to their host country, right? Why? Think about it. uh, unless you are going to retire in that country, unless you're going to retire in that country and live there for the rest of your life, by paying taxes to the U.S. government, they will have their Social Security coming from the U.S. government, right? And as long as the U.S. government pays better Social Security than the governments of their host country, then they would rather pay taxes to the U.S. government. And also if they are going to retire in the U.S. But right, but if they are going to retire in that country, in the host country, the question is then who pays better Social Security, right? And I guess no other country has. I mean, although they talk about U.S. Social Security system going bankrupt, in around 2030, because too many people are just taking government paid stimulus. This is one thing. During the pandemic, government paid out a lot to people who lost their jobs due to pandemic. But even after the pandemic, the recession due to pandemic was only brief. Actually, during the pandemic, even until this summer, right? Even until this summer, like June, July, the economy was booming. Why? Because government paid out too much stimulus paycheck. I mean, some people deliberately are not taking any jobs because they're paid what they get from stimulus paycheck was greater than their and the not the stimulus paycheck, not only the stimulus paycheck, but like unemployment benefit altogether was greater than what they otherwise could earn. But then they are forgetting something. If you are using unemployment benefit now, that will come out. It comes out of your Social Security. So later, when you really retire, then you get that much less because you have advanced it already, right? Because you advanced it, so then you can't get the same amount later, right? And because of these people, if the Social Security runs out of the fund, people who have paid in all their lives won't be able to receive any. Of course, the Social Security is not what I pay. Social Security is not what you is not that the Social Security. What should I say? It's not what you get, you get what you pay. It's not you get what you pay, right? It's not like you pay now and you will get it back later. No, it's not like that. It is financed by. I mean, the Social Security check that the retirees are getting now is paid for by the people who are working now. You understand? So, if the future generation, if the future generation is making less income, paying less social security taxes, then the current generation who will retire in the future will have smaller check. All my life I may have paid into the social security system. Maybe all my life I may have paid in, $5 million or 3 million, whatever. Maybe not. But let's say all my life I have paid in $2 million into my social security check. Uh, it I don't get back $2 million. It depends on what the future generations, what the working age population is paying into the system. In other words, this uh, overlapping generation model, overlapping generation, right? Or intergenerational model. The working population now are paying into the system, and the current retirees are benefiting from it. And when I retire in the future working population will pay into the system, and I will benefit when I retire from that. But if the future population of the future generation dwindles, future generation, working population of the future generation gets smaller, and the average income they earn is smaller, the social security taxes they pay will be smaller. And the current generation who will retire in the future will be at disadvantage, right? So this is the problem with the oh wow, now it's 11:34 now. So this is the right time, just like the last break. It's a good time to take a break. So we will reconvene at 11:45. Okay, to make it 11:45.
Okay.
Right?
All
All
right.
right. Let's take a 10-minute break. Okay, 10. All right, we're back. We're back. Really, 10 minutes really fly by, like, you know. So now that wraps up everything about the that wraps up everything about the first topic, and now we're moving on to the financial statements. I mean, you know, financial cash flow analysis. Cash flow analysis is also part of the financial statements, but I told you cash flow analysis is like it's literally analysis. It's also called statement of cash flows, but it's cash flow analysis is a better term. Why? It's a better description because as opposed to the balance sheet and income statement, which is primary statement, right? Cash flow analysis is the literally the analysis of the income statement and balance sheet. So we have, if you go into this slide, right, there's a lot of, you know, preliminary information, right? But all of those, you know, preliminary informations you can just read up. But, you know, what's important is that, you know, something means, you know, I mean, what if increase in certain account means, you know, cash inflow, but increase in certain account means, you know, cash outflow. I mean, how, in other words, you must analyze where the money has come from and where it has gone to, right? And by classifying sources and uses of cash, sources and uses of cash. And I think this is mentioned maybe at the end. Yeah, this is very important. Cash and non-cash line items. First of all, in the income statement, think about it. In the income statement, right? In the income statement, you have revenue, right? But revenue, not all of it is cash, right? Think about it. Let's assume, I think I need to go back to the financial statement, but this is a little different financial statements, but different, you know, slide from what you're using. This is a slide I use for Finance 100. In this example, net revenue is $236,500. Not all of this is cash, right? You have to understand why. Some of it is accounts receivable and promissory notes, remember? Some of that is cash. I mean, some of the revenue may be cash, but some of it is promissory notes and accounts receivable, right? Invoices, right? And promissory notes. So what is shown in the income statement is not all cash. Okay, you have to keep in mind. Also, in the balance sheet, if the asset increases, asset like, you know, either, you know, physical asset or current assets, right? The liquid assets. When assets increase, that means, you know, increasing, you know, if assets increase, let's say fixed assets increased, plant and equipment increased, or building and land increased. How could it increase? You must have spent money. In other words, you must have, used cash. So increase in assets means use of cash. That's outflow, cash outflow, right? And then also marketable securities increased, promissory notes increased, accounts receivable increased, inventory increased. They all mean use of cash, because you'll have to pay cash to increase inventory, and and let's say stocks and bonds increased. Stocks and bonds increased. Marketable securities such as stocks and bonds increased. What does that mean? You used cash, right? You used cash. In case of promissory notes and accounts receivable, it can hardly be associated with use of cash. But think about it. That means you sold your goods. You sold your goods, right? You sold your goods. That means, your products were produced and sold, right? But you didn't receive cash. But basically, you must, before production of your, goods, the direct inputs, right? Capital, labor, and raw material went into that product. So that much cash was used. I mean, you had to you had to pay for raw material, you had to pay for capital usage, you had to pay for labor, right? But most of the times, increase of assets, like in the fixed asset, right? In the real asset case, increase in real assets of fixed assets, that clearly used cash, right? That's use of cash. And then if assets decrease, that's the source of cash. What does that mean? You sold off some of your equipment. You sold off some of your equipment. It can also include the company vehicle. You sold off company vehicle, right? Assets, fixed assets. Then that means cash inflow is the source of cash. Okay? Increase of liability means source of cash, because increase of liability means you borrowed money. When you borrow money, that's inflow of cash. But if the liability decreases, right, that means use of cash, because you have liability means it's the payment that you deferred payment that is going to come in the future, right? The payments you have to make in the future. So if liability went down, you used cash, you paid off, right? So so this is how you identify the cash flow, right? And all the companies, all the businesses are engaged in three types of activities: operating activity, investing activity, and financing activity. Operating activity is income statement, right? Income statement activity. I talked about this very clearly because earlier, right, when we were talking about income statement, balance sheet, I told you in the income statement is basically the income statement is basically the representation of your operating activity. So it's from here, income, it's basically, from here to here, right? That represents, why is it purple? I thought it was, okay. Okay, let's do this. So from this stage to this stage, that's operating activity. That captures the and describes the operating activity, right? That's okay. Um, and then investing activity is basically, so operating activity is income statement. Investing activity and financing activities are all represented in the balance sheet, right? Investing means, buying fixed assets, right? Firm buys or sell fixed assets that enable it to do business. Long-term purchase and sale of financial assets, right? That's uh, investing activity. Financing activity is borrowing money, paying off loans, sell stock, pay dividends. That's financing activity. In other words, you will need to you will need financing activities to support investing activity, right? To buy fixed assets, right? You need to borrow money or sell stocks, right? Uh, but getting rid of fixed assets, right? Um, like selling fixed assets or selling financial assets are part of investing activities. Financial assets like sale of financial assets. That means getting rid of your selling your accounts receivable or promissory notes. That way, because the money raised from that can be used for investing activities. Now, so let's take a look at two examples. But first, um, buying a car, right? On credit means, of course, that means loan. You got a car loan. So for all cash flow analysis, but not only for cash flow analysis, even for horizontal analysis. Horizontal analysis, you may remember, horizontal analysis means intertemporal analysis, meaning how much each of these line items have how much these line items have changed, right, over a 1 year period, or over a certain span of time, right? And I think it was one of your homework one. Yeah, here, at least here we have. Oh no, it's not. maybe not. This one is not. Okay, I think this was an example of horizontal analysis, and yeah, this one, horizontal analysis. It just doesn't have that part, um, uh, the change, change in dollars and change in percentage, right? But to do this, obviously you will need two balance sheets, right? Balance sheet at time 0 and balance sheet at time 1. Time 0, time 1. This is as of end of 2008, end of 2009, right? Uh, and then to see how much has changed, right? And then change in percentage. That's called, horizontal analysis. And of course, the change is simple. It's just this divided by this minus this. And then percentage change is this over this. Give that to this place. The font looks bad, so I'm going to change the font. And then you can, this is basically, you can just drag it down and, right? And wherever there is no.
Thousand.
What? Say that again? Someone said something? Did someone say something? Or was it not? It was just the background noise. So, this one is there. No change in the depreciation. I'm just showing you this because, we need to understand the change, in our balance sheet, right? We need two balance sheets, at two different time points, time 0 and time 1. And income statement. An income statement is the result of the operating activity, right? During year 2009. I mean, this is end of 2008 and end of 2009. What happened between end of 2008 and end of 2009? Operating activity happened. In other words, income statement happened. Income statement happened. Why is it all 11.33? 11.11. I think it is automatically set up to be like that. It looks like it's all artificially. I think it was all artificially 11.11. Everything. The rate of change is all. That's interesting. Oh, you know why? Because I made everything. 2008, everything, 90% of 2009. No wonder. Everything is, see, everything is 90% of 2009. So I just made it artificially like that. So no wonder, then you divide this by, which is 10% of this, right? Divide that by 90%, it's going to be 11.11 through and through, right? Because the data was artificially generated. But now, back to our discussion of cash flow analysis. So we need two balance sheets, right, and one income statement. Here we have income statement, okay, and then the balance sheet. It's an individual, so individuals don't have balance sheets and income statement, but at least we record, very basic uh, entry, right? So at the beginning, and at the end, T0, T1, at time 0, time 1. So we have two balance sheets, right? One income statement. Let's take a look at the balance sheet first. So at T0, at time 0, Mr. Jones had $10,000 in the bank already. This is his current asset, right? His current asset, 10,000. His savings in the bank. He didn't have any car. Car is a fixed asset. Current asset, non-current asset. No non-current asset at the beginning of the year. His total asset is 10,000. Yes. Liabilities and equity. His money in the bank is his equity, his own money, right? So he had equity of 10,000. And since he didn't have any car at time 0, he didn't have any car loan, so 0. So total liabilities and equity is 10,000. So total assets and total liabilities and equities, they balance out. And during the year, he had the income of 50,000, right? And his expenses, living expenses, 40,000. So his net profit, in this case, his net income, right? Because he's not a business, right? So we don't call it profit. Net income is 10K. Net income is equity because he owns it. I mean, he doesn't owe this to anyone, right? So in other words, cash in the bank is his equity, right? It's his equity, and it's his wealth, right? His wealth. Income and wealth are separate, right? Wealth is the stock of all the savings, or all the accumulation of his net income. That's stock. So that's stock of his stock of his wealth. That's equity, right? And this is his net income. Net income is also part of his equity because he wholly owns it. I mean, it belongs to him. He's the owner of this income, right? Net income, and it's generated by his operating activity. In other words, his operating activity is what? His operating activity is selling his labor, right? Activity involved the activities that he undertook to generate that net income, right? So it's his earned income. This is his earned income. This is his, net earned income after, right? So this is in terms of, capital component, right? Or in nature of capital, this is equity, right? So by the end of the year, right? At the end of the year, his cash in bank is 15,000. Why? I mean, shouldn't it be 20,000? Well, his equity double to 20,000, right? Because adding this net income to his equity, so it's 20,000. But he got a car loan of 25,000. Why? He bought a car, and the car price of the car, value of the car is 30,000. So to pay for 30,000, he used this car loan of 25K, and he used 5,000 from his net income. So 5,000 of his net income, right, turned into and the car loan of 25,000 turned into this car, right? Makes sense. So, but basically, his assets are $15,000 in the bank now, right? And then $30,000 in car. So he has current asset and fixed asset of 30,000. So his total assets is 45K. And now his liabilities and equity is also 45K because he got the car loan of 25K. His equity is 20K, right? Of course, 5,000 of that equity went into the car, right? So his total liabilities and equity is also 45K. So it balances out. It balances out, right? That's why it is called the balance sheet. It must balance out. And if we construct this cash flow statement of cash flows based on this, right? Based on this, his cash income was 50K, right? That's cash income. Cash used for living expenses is 40K. So this is cash outflow. This is cash inflow. Therefore, this is cash outflow is expressed as negative, right? That parenthesis is negative. So net source of cash from income is 10K. And use of cash for buying a car, 30,000. Source of cash from the loan, 25K. Right? And the other 5,000. Net cash, so and from this 10K, he used 5,000 for this car, right? So this plus, right? You add them up, right? That's 35K minus 30K. So net cash inflow, 5,000, right? And then we break down, in other words, it's already broken down, but reconciliation, meaning, we make in other words, we make our story add up. Why do we have our ending cash balance of 15K? Because there was beginning cash balance of 10K and the net cash inflow of 5,000. Therefore, ending cash balance 15K. Okay, so this is the cash flow analysis. In other words, we are tracking cash inflow and cash outflow and come to the ending cash, net cash, right? Ending cash balance, and bringing it to the ending cash balance is called reconciliation, right? So basically, this is cash inflow at the beginning, right? And then net cash inflow, right? During the year, right? Okay, so this is a very simplistic, a very simplified, simplistic model. The reality would be more complicated. So we're going to look into a stepped up, one step up, right? A stepped up model example and a corporate case, corporate example in the next class. Okay. So we are already out of time. Actually, 4 minutes past the hour, past the time. So I'm gonna have to call it a day here. I'm gonna have to call it a day, and I will see you guys next Saturday. I'll see you guys next Saturday, right? So have a good rest of the afternoon, and you have a good weekend. And it's Columbus Day weekend, right? So if you have any class, Monday, um, I don't think there is any class on Monday. Okay.
Yeah, there's no
All
class
righty.
on Monday.
Yeah, that's right.
The
All
weekend.
righty.
Thank
All
you.
right. You too, Anna. You too,
Thank you.
Tina.
Have a great weekend.
You too, Janet. Take care, everyone. Have a great weekend. Okay. I'm gonna stop recording, stop sharing, and stop recording and sign out. Okay.